Max, what's that first thing say? Number one.
Basis for tax purposes. Is the concept of basis a static, unidimensional concept, or is it a varied concept? And it is varied.
Okay, and it took me a second to remember why the hell I was saying that yesterday. And the reason I was saying that yesterday, as we introduce um, hurdles, loss hurdles, that's what we're talking about. Uh, Basis are two pieces, excuse me, two hurdles that have to be confronted because it goes basis, at risk basis, passive netting, excess business loss. Does that sound right, Stephen?
Yes.
I think Stephen's going to keep me on track today. Okay, so the reason that is up there is to say, well, wait a minute. At basis and at risk basis, you have to use the proper lens to
Diagnose.
diagnose whether you have basis in order to hop that hurdle. So the hurdles, the reason they're called hurdles, or it's phrased that way, is you have to hop over the first hurdle because you diagnosed that you could, correct, Sam?
Mhm.
And then you have to hop over the second hurdle, and then you have to hop over the third, and then you get to the fourth, and it's not a hop, it's an analysis. So if you ever trip on a hurdle, then the loss gets stuck and doesn't make it to your 1040. So said differently, you were allocated a loss from some venture or some activity. The hurdles help you, Sam, diagnose whether it will get to the 1040 or not. And if it trips up at any of the hurdles, then it doesn't get to your 1040. It stops. It gets hung up and has to be carried forward to the future year. Carter, you look like you have a question. Nope. Okay. Carter, what's number two say?
In what ways or how is basis a varied concept? A. Sale or exchange of an asset. Basis is utilized in determining gain or loss. Can a
Okay. And
tax
what's my definition of proceeds?
cash plus property plus debt relief?
Okay. And then what's B say?
Can a taxpayer take a loss? There are the hurdles a taxpayer has to jump in order to take a loss.
Okay. So this is at some point later, there's a better rendition of what this is. And I haven't taken it out because, we learn by fumbling about and screwing things up, don't we? That's how we learn. So this was the first version of probably when I have better in the future, somewhere in the future slides. But so let's where the fuck's mine? So what did I say about the hurdles were? My description. There's a loss. Hurdles help you diagnose what? Whether it gets to the 1040 or not. Okay? So the first hurdle that the loss has to jump over is basis. And if it does that successfully, then you have the next hurdle that you have to jump over, or Sam, diagnose, which is at risk hurdle. And if it jumps over that, then it's passive, something called passive netting. And if it jumps over that, it gets to your 1040. And now you have to worry or do the analysis of excess business loss. Okay? So you have hurdle one, hurdle two, hurdle three, and then analysis is what happens. Okay, so this, and just to put a bow on it, if I have a W-2 of $200,000 and I have a loss from a K1 of $200,000, because you're going to get a K1, right? K1 is something that's familiar to everybody in the room. So now you have this K1, and now you have to do a diagnosis of whether it jumps over all the hurdles. And if it successfully jumps over all the hurdles, then it makes it to the 1040, and you have zero taxable income. But if it doesn't jump all the hurdles, And I'm going to say it trips up at risk. The 200,000 is a carry forward to the next year. Okay, so basis. Do I have basis in the asset? First of all, do we ever come up with a reason somebody would never have basis in their asset? I can't think of a reason why somebody wouldn't have basis in their asset, honestly.
Could be zero. Contributed. If you fully depreciated it and then contributed it.
Well, I mean, we're talking about partnership interests and S Corp. So yeah, you have zero basis in your S Corp stock. Fair enough. Okay. Do I have basis in the asset? The asset generally is going to be this. When I say the asset, what I mean by that generally is going to be a partnership interest, 1065 K1, an S Corp K1, or a Schedule C. Something that generates a loss that you have to do an analysis of whether it can jump over those hurdles to get to your 1040. Okay, if it does have basis, do I have at-risk basis? We're going to talk about what at-risk basis is, but are we here to be experts, Chris?
Nope. We're
We're
just
not.
building a foundation.
We're building a foundation. So at-risk basis, from your perspective, okay, I'm going to give you a couple different categories that you probably want to pick up and carry along with you. One is, can somebody come take your house? Can somebody come take your car? Can somebody come get your bank account? Are your outside assets at risk to the exposure of what liability is embedded in that partnership? So, Chris, you're in Partnership A. Partnership A buys a building and you guarantee the debt. Okay? And it's an LLC. Partnership building goes down, doesn't do very good. It's sold, comes up short on the debt for $100,000. Can they come get $100,000 worth of your stuff? And I don't care whether you have $100,000 worth of stuff or not. Can they? You guaranteed it. I guarantee it's going to get paid.
Exactly.
Do you guys understand the concept of guarantee? Guarantee is I'm going to back whatever that debt is with my personal assets, and if it fails, I'm going to pay it. So the concept of at risk is, do they have the ability to come take my assets for debt I don't have? I've guaranteed it. I'm at risk for whatever that debt is. If the answer is yes, then you go to passive netting. So the loss, so let's talk about this for a second. This loss, this assumes that you've jumped hurdle 1 and you've jumped hurdle 2. Okay? I'm going to say you have a K1 from business A and a K1 from business B. And each of them have a $200,000 loss. Okay, so K1 from business A has 501 hours. This is hours. And why am I talking about hours? CB.
Because when you hit 500 hours, it becomes non-passive
Okay,
and passive.
exactly right. Everybody's on board with that with CB. We hit 500 hours. So since this is not passive, it jumps this hurdle and doesn't even have to think about it. It just jumps right over that hurdle. It doesn't even acknowledge it exists. However, this $200,000 amount, how many hours did I spend in that CB?
200.
So is it passive?
Yes.
If you're a good tax guy, what would you do to analyze whether we should convert that from passive? Anybody?
Grouping election.
Grouping election. Can we group these to not have that problem? Okay. And the grouping election under businesses, is it harder than easier than real estate, Max?
Harder.
It's harder. Why?
You have to kind of find that, like, do they kind of relate to each other?
Do they relate to each other? Do they have common management? Do they have common geography? Do they have common business enterprises, do we have the ability to group them together? Okay. So we can't do that. You guys did that analysis. We can't group them. So now business activity B has basis, at risk basis, and we get to the passive, and now we have 200,000 of loss. So, CV, who you want to call on?
Jackson.
Jackson. If you were going to describe to your peers in the room what passive netting is, what is it that you do?
Essentially, you can't offset non-passive income with passive losses.
Okay, that's step 2.
Okay.
What's step 1? In order to determine that you have an overall net loss, you have to compare every passive activity that you have. So if you have four passive activities, and 2 of them have income and 2 of them have loss, you are able to add all those up and put down to either a positive number or a negative number. Okay, and if you put down to a positive number, then all the losses has been used against the passive income that's been generated. If it puts down to a negative number, then you trip up at this hurdle right here. So the passive netting is quantifying what you have in your return as activities that are your passive activities. Once you know the universe of items that are passive in your return, you foot them down, and if it turns out to be a positive number, the passive netting doesn't matter. But if it turns out to be a negative number, now you trip at that hurdle and it doesn't get to your 1040. Okay? Let's see. Is the loss from a passive activity? No, go to excess loss. Yes, you do the passive netting. And what did I describe passive netting as, Jackson?
You're comparing all your sources of passive income.
And passive losses and putting it
Yep.
down and see what I got.
Yeah, positive or negative.
Okay. If the passive loss exceeds the passive income, the loss is suspended and carried forward, meaning that's the hurdle that we trip on, and it doesn't make it to the 1040. Okay, business loss. Once you jump all these hurdles, in 2017, I think they came out with a rule that said, well, wait a minute, if you have $1 million loss on your 1040, you can take that $1 million loss against all your income prior to 2017, offset it against all your income, and this excess business loss concept did not exist. The excess business loss came into play in 2017, I think. Do you know?
I think COVID delayed it for a couple years.
He said COVID delayed it a couple of years. I believe you. I have no idea. Probably. I'm sure you're right. Okay. So excess business loss means that now I've gotten all the losses over those hurdles. Now I have a group of losses, a loss or group of losses. I have to add them together, and now I have to make a determination. Is it what is the filing status of the person who has the loss? Is it married filing joint or is it married separate? Married separate cannot have a loss more than $250,000. So if I change the facts over there and change my 200 to 600 of loss, married separate would have, or 650, would have 400,000 of excess business loss. They would get to deduct 250, 450 would be excess business loss, and that excess business loss gets carried into the next year and gets released in the next year, and we'll talk about that. Okay? If it's married joint, it's 500,000. So if I had $600,000 of loss, 500,000 would release into the return, and 100,000 would be carried forward and dealt with the next year. Have I said anything stupid yet, Stupid? You doing all right? CV, who you want to call on?
Max.
Is basis a constant number or does it adjust? Basis adjusts up and down.
Okay, what's D say?
In what ways does basis go up or down? Basis most common starting point is acquisition costs. Property that was inherited gets a step up in basis. For example, my father owns a piece of ground with an acquisition cost or basis of 100K. Dad passed away and daughter inherits the ground. The ground had a fair market value of 1 million at the father's date of death. The daughter's basis in the ground is 1 million and not the father's 100K.
Okay, does that seem consistent with what we said yesterday in the estate and gift portion, where we had to take the fair market value, compare it to of the assets in the estate, compare it to our estate exemption, and figure out whether we owe a tax? So that's a consistent concept with what we had today. But for purposes, and this is one of those things that there's a multi there's rules that you can branch out to other concepts, and this is one of those times. If I have stock that has zero base in it that's worth $1 million, and I die, and I leave that to Stuthman, and it's worth now $1 million, it goes through my estate. Now he has $1 million of basis that he can use for those hurdles. So knowing now his basis adjustment is adjusted for hurdle purposes seems like it might be useful. Okay, go ahead.
Property improvements, new roof on a building.
Yep.
As corporation stock basis and partnership basis, in general, basis adjusts up and down based on acquisition costs, which increases basis, contribution to entity increase, income allocated on K1 increase, losses allocated on K1 decrease, non-deductible items decrease, distributions on cash or property from the entity to shareholder or partner decrease.
Okay, so is everybody who in the room is not very familiar with that concept? Is everybody in the room is familiar that basis in a partnership and an S corp adjust up and down based on the activity that is on that's reflected on that K1, and that's a familiar concept to everybody in the room. Okay, so why that's important, okay, is if we get tripped up here, and we're going to talk about this, we didn't have basis for this 200,000, did we? We did not. And that came from K1A, or came from whatever, right here. If the next year we have $300,000 worth of income, did my basis float up because of the income on the K1? Do I have a carry forward to the 200,000 from the year before? So now we have to redo that analysis of that hung up loss, and by virtue of the basis going up by K1 activity, it releases that loss, and now I have a net $100,000 that, assuming I get over the passive, right? But I it'd be passive either way. I got a number bigger. Okay, so the floating up or down is a release mechanism for losses that get hung up. Huh? You want to read E?
You got you.
Okay, who you want to call in?
Connor McCraddock.
Number 3, as a tax professional, what items may be examined to determine basis? A, acquisition cost, B, non-recourse debt basis, C, recourse debt basis and qualified non-recourse, D, loans to entity by partner or shareholder.
Okay. You know, sometimes I think I'm catastrophically stupid, and this is one of those moments. Well, shouldn't we write down adjustment of by K1 income and expense and other items? Shouldn't that be on there? I was making a more specific point when I wrote this, and I was so stupid to make in the pursuit of making a specific point that I just made a point that basis adjusts up and down, and I leave it off here. That doesn't seem very smart to me. The point that's being made, Connor, what's 4 say?
Do acquisition basis and debt basis provide a shareholder or partner identical characteristics for distributions from an entity and a partner/shareholder ability to take losses? Question.
Okay, this is one you should highlight. This is one that you should put a post-it on. Because to me, did you understand this immediately, Stuthman?
No.
No. I think you guys might be able to set the bar higher than Stuthman, but we'll see. So let's do that again. Connor, what's that say?
Do acquisition basis and debt basis provide a shareholder and partner identical characteristics for distributions from an entity and a partner/shareholder's ability to take losses?
Okay,
Right,
so let's go back to what we said before. Basis is something that is acquisition cost. Basis is something that is adjusted up and down for K1 income. Basis is adjusted up and down for if we put improvements in it. Basis is adjusted up or down by somebody dying. But this whole concept of debt, the things that I just said, basis going up and down by acquisition, K1, and other things. Those concepts are easily, in my view, probably more easily consumed and understood to build what, Matt? The foundation. Okay. And this is foundational, but this is confusing a little bit. Okay. So we have row 1, acquisition cost. And let's go back to why is it that we're talking about this again? What are our hurdles, Max?
You got basis, got at loss
At risk.
or at risk basis.
Yep.
You've got passive netting and like excess business losses.
Okay. So this question is focusing on, Chris, this question is focusing on which hurdles of basis, at risk basis, passive netting, and excess business loss. First two. Okay. So now there's a reason I'm bringing that up, because now you have to go, well, why is he saying 2? Why is it affecting 2? Because you have basis and you have at risk basis. Okay. So I'm saying acquisition costs, which everybody can wrap their head around. I bought something for $200. My acquisition cost in that item is $200. Everybody can wrap their head around that. Okay. Loans by a partner or shareholder to the entity. So Stuthman owns organization B. Stuthman makes a loan to organization B of $100. If Stuthman is the lender to that organization, that gives basis. That provides basis. Okay. Recourse debt and, that's, for those that actually want to write it down, because it kind of is important. And evidently I was drinking again and I was lazy. Was recourse debt and qualified non-recourse debt. So just for a moment, if you guys can pull up in your head, what does a 1065 K1 look like? There's a section on the 1065 K1 that talks about debt. In that section on the 1065 K1 that talks about debt says there's it's probably in here. So I guarantee it's in here. Okay. It's somewhere in here. Talking head yet again. There's a recourse line. There's a qualified non-recourse line, and there's a non-recourse line on the K1. So the words that you really should be writing on your page, because I was too stupid and lazy to do it, was qualified non-recourse. And then the last line is non-recourse. So for a partnership, this is saying, shareholders' ability to take losses. Fine. I'm okay with the way that's written. Okay. So the hair I was about ready to split is, does it provide basis? The last sentence, does it provide the person the ability to take losses? Because at the end of the day, what I'm saying is you've got to be able to hop over 1 and 2. Does it provide me the ability to hop over those first 2 hurdles? And what this is saying is acquisition cost allows you to hop over hurdle 1, basis, and hurdle 2, at risk basis. Loans by the shareholder to the entity allows you to hop over the first hurdle of basis and the second hurdle of at risk basis. Recourse debt, which, Chris, what's recourse debt?
Is that when They can come after your personal life.
They can come after your shit. They can come after your assets. Okay. Recourse debt and qualified non-recourse debt provide at-risk basis and at-risk basis. So I'm sure I have it in here somewhere, but I like to repeat things. Do I not, Chris? I do, but I think that's pretty good because you guys are able to. Huh?
You said you like something.
Son of a bitch. That was just a yesterday thing. I'm reneging on that because I say a little too much, more than I think. I'm going to take that one back because I thought I'm stepping back and I'm like, I'm like, what the fuck am I about ready to step on back here? Fuck, that just completely took me off my train of thought too. What was I talking about? Oh, repeating things. So this is worth repeating. Okay. And I think we're going to talk about this. There's this concept of qualified non-recourse debt. And qualified non-recourse debt in general, and I'm not the world's best at this definition. I'm better at the definition of what a 1231 piece of property is. So take this with a grain of salt, but I think I'm right. Is qualified non-recourse debt is debt on real property loaned by a governmental agency and secured by the property itself. Does that sound about right? Stuthen says it sounds right. And he's taking a master's in master's in partnership class, haven't you?
S corp.
Was it S corp? Oh fuck. Okay, whatever. All right. So, qualified non-recourse means that that's debt that was on a building that was loaned by a governmental agency, or something to do with governmental, which all banks have, the FDIC, so on and so forth, and it's secured by the building. So recourse, where Chris, they can take what?
Yeah.
Right. On qualified non-recourse, they can't take it. But by definition, it's qualified non-recourse if it's a building inside the entity that has a loan on it by a governmental agency that they can come take the building. So why, pushing aside loss hurdles for a second, in what way can this information be useful to you people? Luke?
I guess recourse, what partners have debt that they need, or that they have to back up, in a partnership.
Okay, that's not a bad answer, but if you take it to the next step, if there's recourse debt on the balance sheet of the partnership and you and Sam are partners and you're the guy giving the guarantee, there's $100 of debt. Is your recourse line going to say 100 and his 0, or is it going to be 50-50?
I guess it depends on the agreement.
You gave the recourse, you gave the guarantee.
So then it's me.
So the point of this is you have the analysis, you have to have the ability or the potential thought process to develop here. As we're talking through this, the K1, that section, is going to tell you who has what debt in order to be able to, Sam? Diagnose what hurdles you're able to jump over. So as you're prepping your 1065s, one of the questions that you should be asking is, okay, AP. Do you think AP is going to be spread ratably among everybody? Yeah, it is. But other debts on there might be qualified non-recourse, or it might be recourse, and you asking Brad, the super reviewer guy, can you ask client, can you give me a schedule of who this is allocated to and put that in work papers? Not a terrible idea. Actually, it's a really good idea. Okay? So recourse, which is what, Chris?
They can come after your shit.
Yep. And then qualified non-recourse, Jackson, is what?
It's a special rule where it does increase your at risk, but
It's associated with what, though? How do you...
I think you said, was it something along like a governmental building?
No,
lost you
it's
there.
any sort of real estate. So Lutz owns, let's pretend Lutz owns this building. Okay, and Lutz is a partnership. And we get a loan from a bank. Okay, so we bought this for 10 million, got a loan for 8 million. And the bank says, well, we want a lien against the building in case you don't pay. So it's the building, loan from a bank, basically. Not, if I was the lender, it's not qualified non-recourse because it's not backed by governmental. And the bank has a lien against the building, That would be qualified non-recourse debt. Okay. But I couldn't take Chris's.
Shit.
Yeah. Okay, and then there's non-recourse. So non-recourse doesn't give you the ability to take the loss. So, and we'll get there. Non-recourse gives you basis. Non-recourse doesn't give you at-risk basis because you're not at risk. So this qualified non-recourse debt is this weird middle ground that even though they can't come take your stuff, they still give you basis for loss purposes. I'm not sure exactly why that is. And, for me, knowing why something is helps me be able to consume it and explain it, but that's one that just is. Okay. All right. So, now take whatever note you want on this that makes you remember. Okay. The top part, it says deduct loss partnership. The bottom part, the second part says deduct loss S corp. This is if a loss is coming off a K1 and out to you so you can diagnose whether you're jumping over the hurdles. Okay. Distribution from a partnership or distribution of S corp. Now this is saying, do these various types allow you to have basis for distribution purposes? So, why do we measure basis for distribution purposes, Carter?
Because like someone's basis when they contributed to someone else might be a lot different than when the person like actually inherits the basis.
Let me be more precise in my question because I didn't do it very well. If you have basis of $100 in a partnership, or you have $100 of basis, and we'll call it acquisition cost let's call it basis because now that's going to cost me a problem. $100 of basis, and the S corp distributes in a distribution to you $200. What happens?
Yeah, you'll have to report like a gain on that.
Okay, so this piece is saying, and that's called distribution in excess, is it not? Is everybody in tune with the terminology distribution in excess? So this helps us, what, Sam? Diagnose whether we have a distribution in excess or not. So for a distribution from a partnership, acquisition cost for distribution purposes. Loan from a partner counts for distribution purposes. Recourse and qualified non-recourse counts in a partnership for basis. Non-recourse debt counts in a partnership for basis. Now, let's talk about S corp though. Distribution from an S corp, acquisition cost. The rest are no. And that's just a difference between S corps and partnerships, and that you need to drill into your head in terms of how an S corp shareholder interacts with debt and how a partner in a partnership interacts with debt. Because there's a lot of yeses on one side and there's only one yes on the other. And the one that kind of freaks me out the most, quite honestly, and I didn't know this until I'm going to say the last five years, was a loan by the partner or an S corp shareholder, to the S corp didn't count for basis. I'd say for the first 20 years or 25 years of my career, I would have said yes, that counted towards basis, because it kind of freaks me out that it doesn't. And I don't understand the impetus of why it doesn't.
So you can use shareholder loans to create loss situations, so you can deduct a loss in your individual returns, but you like if you receive distributions in excess of this basis, that loan from the shareholder doesn't help.
It does not. It does not. And I learned that because somebody in the building lost that on an IRS exam. And I thought, well, that's weird. And then I went and looked it up because I said something about we need to be intellectually curious. When that went the other way that I expected, I'm going to go look it up and figure out that that's actually a rule. And part of why that might be, maybe, is, and this is worth knowing, and this is probably closer to expert, because it's not a hard concept, but it's not a concept you're going to trip on very often, is that and this actually, the more I think about it, this actually might be the reason, is from a loan from a shareholder if pushing aside losses, pushing aside distributions, pushing aside some of those things, I'm going to say that Stuthman had $100 of acquisition cost, and Stuthman had $300 of loan in the corp. Acquisition of 100, loan of 300, total potential basis for loss 400. Year one, the S corp kicks out a $400 loss. Okay, so this is K1 loss 0. So now you have 0 basis in your stock, and now you have 0 basis in your loan because you used the loss to send out. So the rule is, well, now the company is going to pay Brad $100 on the loan to him, but we've fully written off the loss against it. Matt, is that a capital gain? Is that an ordinary loss? And it's the third answer. It depends. Okay? And what it depends on is, and this is so stupid, I don't know what to do with it. I mean, this is genuinely stupid to me. Is that if Brad said, corporation, I'm going to loan you $300 and we're going to execute a written note. Here's a note. I'm loaning you $300. We're both going to sign. I, Brad, as lender, am going to sign as the lender, and I, Brad, as the shareholder or the cops of the corporation are going to sign. And now we have a note. The IRS says that the note is property and that the payment of $100 since property exists is a capital gain. If Brad just lent it with no written note, then it's ordinary income. It is so stupid, I don't know what to do with myself. I don't know why they both just don't default to capital gain, because to me that they both feel like distribution in excess. And it feels like when I say that ought to be, basis for distribution, that's probably why they say no to that, because of that distinction, maybe. Brad, you look like you want to say something. Nope, you're good.
Is distribution in excess, what is that tax at?
Both for partnerships and corporations, it's deemed to be the sale or exchange of that particular equity interest, so capital. Not for the note, though. Not unless you write the note.
Do contributions to a partnership decrease the individual's taxable income?
What do you mean by that?
Like if I contribute 100,000 to my partnership, does my individual 1040s my taxable income down?
The contribution is the only way that would be true, Sam. Let's take it two ways. If I contribute $100,000, that the only thing that's going to do is increase the basis I have in the partnership. So that's not going to be an income event to the partnership. It's just going to be an increase in the cash and the equity in the partnership, and it's going to be an increase in basis to you. The only way that that's going to be a reduction to income to you is if that contribution, you have this $200,000 carry forward. Going back to the K1 example I said earlier, if the K1 generated $200,000 in year 2 and you had this carry forward from year 1, that $200,000 of income would be a basis increase. And since we have a basis increase and an at-risk basis increase, it would release that $200,000. So if you contributed the $100,000 to the partnership, it would be the same effect as that increase in ownership for or increase in income, increase in basis from the income from the partnership. So the mere action of contributing something wouldn't affect income either way. It would increase basis, which could affect income if you had at-risk carryover. Okay. So, and I'm telling you, I tried to do this about 6 different ways through this to try to get these concepts across. And so far, Brad was at your group when I was doing this. I'm like, you guys are so fucking lost. I don't know what to do with myself. And we had to retrace.
Yeah.
I mean, I could tell that I was talking and everybody in the room didn't know what the hell I was talking about. So what happened yesterday when the camera kind of quit. I'm like, fuck it, let's get out of here. That's kind of what happened with these guys. I said, okay, I've lost you. I have not captured you, and you guys don't know what I'm talking about. So, if that happens, you still got to raise your hand. I'm sensing that you guys are with me so far. So, and again, this is a hard concept. Basis for partnership purposes. Oh, okay. It took me a second. Okay, so highlight the words Form 6198. The 6198 is the form in the 1040 that allows you to measure at risk with at risk basis. It helps you diagnose your loss carryover. Okay. So what this is doing is saying, well, there's debts that exist at both the entity level and the shareholder level, and you have to think about both of them in order to, Sam, diagnose what your at-risk basis is. Okay, so I'm saying at the entity level, non-recourse debt, meaning AP, gives you basis, but you have to stop there. It doesn't give you any more than basis. You're not at risk for it, unless you give less guarantee for the tax returnability that you owe us, which might happen, but never happens. It wouldn't happen. Okay. Non-recourse debt on land or building, which is qualified non-recourse. I was not so lazy that I didn't write it out there. Gives you basis and at-risk basis. Then you have to do your analysis for the passive hurdle. Loan from partner or shareholder. You know what? Mark out the word shareholder because I'm talking specifically about partnership here. The word shareholder does not belong in there, and words matter. Loan from bank guaranteed by partner, you get basis and at-risk basis, and you get to go to the third hurdle to do the analysis for passive. So, but the shareholder level has a couple different things that are adjusted. Is acquisition cost, loans to the S corp. Mark out S corp. Oh no, S corp actually works here, but mark it anyway because we're talking about partnership. Debt funded acquisition cost, bank no guarantee. Debt funded acquisition cost, entity guaranteed. Debt funded acquisition cost guaranteed. Everything with the exception of the things with no guarantee gives me at risk basis. And this to be more precise, because the more I'm watching this unfold, and the more I thought about the K1 activity not being reflected in here as terms of what does or does not allow you to have basis. This is primarily about diagnosing debt in terms of what allows for at risk. Because going back to this example that I have $200,000 of loss in year one, and I trip on a hurdle, and then get to year two, and I have $200,000 of income from that activity. Well, that increases basis, and that's nowhere in here in terms of how this adjusts. So in writing this, I was not precise enough to say this really has to do about what debt and debt interaction that you have with an entity provides you basis. That's a more precise way of thinking about what this is. Okay, and the next page is basis for distribution purposes, and it's a free-for-all. Everything counts. Every debt item counts for distribution purposes. So now you have to ask yourself, well, wait a minute. This is, and the more you go, the more that you'll see the nuances of things. We're talking about distributions. We're talking about losses, and being able to say, okay, there's debt on the balance sheet. Is my view, is the information on the balance sheet with respect to that debt going to be utilized for loss purposes? Is the debt on the balance sheet going to be utilized for distribution purposes? Because depending on what I'm aiming at, my what will be different, Sam. Diagnosis, right? The diagnosis of what you can and can't use will be different based on what you're aiming at. Because in this case, it's a free-for-all. Everything counts for distribution purposes. And everything counts for a distribution purpose. Sam, are we talking about a partnership or are we talking about an S Corp?
Partnership.
Partnership. And that matters because you're going to see that all this gets turned off significantly for an S Corp. So now not only do we have debt for loss purposes and debt for distribution purposes, we also have to be smart enough to go, well, wait a minute, now we're going to be talking about two different entities. And the fact that I'm talking about two different entities is going to change how I feel about the utilization of that debt depending on the entity. And we're going to demonstrate that. Okay? Basis for loss purposes for an S Corp. Is there anything at the entity level, non-recourse debt on land and building, qualified non-recourse, loan from a bank guaranteed by a shareholder? Is there anything in there that helps with loss purposes? Nothing. So the punchline is the debt on the balance sheet, with the exception of a loan from a shareholder, does you no good for loss purposes for an S Corp. So it's a completely different analysis for both those. So, but at the shareholder level, acquisition costs gets me through basis and at risk basis. Loans to the S Corp by the shareholder gets me through basis and at risk basis. And Allie, do I want a note written with my loan to the corp, or do I want it without a note? If I'm making a loan, I'm a shareholder to an S Corp. Do I want to make sure that I get a loan payable in between me and the corp, or do I just want to do a loan? Just do a loan. How do you feel about that, Matt?
Probably.
You probably want it in writing. Why do you want it in writing?
Because then making sure that it's a distribution.
Nope. Loans from a shareholder do not count for distribution.
Well, I know, but if you don't have it in writing, they see the money go out, then they can think that it's distribution money.
It's not. Okay, so Connor, do you remember why?
I was just using capital gains rates.
Capital gains rate. So if the basis gets driven down, like over here, if the basis goes from 300 to 0 because I've taken a loss, and the company makes a repayment of that loan without the note, it's ordinary to Brad who lent the money. If Brad and the company actually execute a note, then the payment on that note, even though it has 0 basis, is capital. That's what I'm driving at. Okay, so a loan to the S Corp by the shareholder gets us over the basis hurdle and the at-risk basis hurdle. Debt-funded acquisition cost with a guarantee gets you over the basis hurdle and the at-risk hurdle. Debt-funded acquisition with no guarantee only gets you to basis. Now, on this page, I would probably, just for your own benefit, highlight those two lines, and we're going to supplement with a note that is helpful in the future and has absolutely nothing to do with what we're talking about. But it will be helpful, okay? If, and this is true both of a partnership and an S Corp, and I probably should have brought it up with the partnership, is if you have, well, I'm going to keep it an S Corp because partnerships are way more flexible. If you buy stock and you take debt to buy stock, Max, do you pay interest on that debt?
Yes.
Yes. So when that happens on the Schedule E, unless the rules changed, the rule hadn't changed on me, has it? Okay. You can take the interest associated with the acquisition of that stock, put it on Schedule E with your K1, income or loss, and take that interest expense on your Schedule E. So it's acquisition debt interest that you deduct against your K1 on Schedule E. That seems like it'd be worth knowing. If you know you're doing this analysis about debt, you should be smart enough to ask the question is, if there's not interest expense on there on your Schedule E, you should ask about it. And then you'll look like a genius.
Is
If
this
it's,
for S corps or?
it's for both, but an S Corp, the reason I kind of backed off partnership max, it's true for both. That's the short answer. But a partnership, so compare and contrast. An S Corp, if I go out and I, wine and dine Brad to try to get him as a client, and I'm doing it solely in my capacity as an S Corp shareholder, and I paid $500 for a dinner, I can't deduct that. That's an unreimbursed employee expense. Okay. If I wine and dine Brad as a partnership partner, that's called an unreimbursed partner expense. Your ability to write something off with respect to a partnership is wildly greater than it is as an S Corp shareholder. That's kind of why I stopped and comparing and contrast. I probably shouldn't have. So now that you say it, I shouldn't have. Acquisition indebtedness for both of them count as a write-off against that K1 income. I shouldn't have done that. I was overthinking. Basis for distribution purposes for the S Corp. Well, the only thing you got is acquisition cost and debt funded acquisition cost. S Corps are wildly, wildly more inflexible and less forgiving. But in exchange for that inflexibility and less forgiving, they're more predictable and they're easier to think about. How do you feel about a waterfall, Brad?
Not fun.
Not fun. Actually, they are kind of fun. At least you have to think. Who was the last person I called on? You? Oh, I had like 3 hands go up.
I thought it was me. Yes.
Okay, all right. Did you point over? Okay, you can have a vote between the two of you who you want to call on. They pointed at Chris almost mutually. Chris, you just got called on
Yeah,
accident.
right in the middle of a survey.
Yeah.
What's it say?
It was splitting the difference.
Based on the following facts, what is the basis in the S Corp stock? Interest for determining losses and for determining distribution. Shareholder acquisition cost, 20,000. Shareholder loan to the entity is.
Okay, so you'll notice on the balance sheet there's cash of 100,000, AR of 50,000, land of 200, an AP of 80, loan on land of 200, and loan from shareholder of 50. And that should, then we have equity of 100, I think, should be. No? Does that math fucking work? Yeah, it works. Sorry, fell asleep. I have a little bit of a cold. Okay, so with this data, can you tell me, and the answer's on the page, what the basis for distribution is for the S Corp and basis for loss is for, basis for taking losses?
So for loss purposes, you include acquisition cost, and then you also get to include the fund from the shareholder to the entity.
Yep.
And then for distribution purposes, it's only the acquisition cost. As there's really nothing that comes towards that one.
Okay. For basis for loss purposes, first of all, does that clear the first hurdle of basis?
Yeah.
Does it clear the second hurdle of at-risk basis? It does. Okay. And for basis for distribution purposes, you only have the $20,000 that you can take for distribution purposes, which adjusts up and down for losses, gains and losses of the entity, but not for debt to the entity. Okay. Who you want to call on? Chris.
Let's do it.
Allie, what's number 2 say?
The partnership is owned by A and B based on 50/50 Based on the following facts, what is A and B's basis for distribution and loss purposes? No partner guarantees any debt. The acquisition cost for A is 40,000 and for B it's 60,000. To make it go.
I do. What? And tell me what's on the balance sheet.
Balance sheet, there is 100,000 in cash, 100,000 in AR, 200,000 in life for a total of 400,000. Accounts payable is 80,000, loan on the land is 200,000, equity is 120,000.
Okay, and what's the little X at the bottom?
Assuming that this qualifies as qualified non-recourse.
Okay, and then we have a section for basis for A and basis for B, and then 2 columns under each of them, which is basis for loss purposes and basis for distribution purposes. Okay, so let's look at A.
So for basis for A, basis for loss, the acquisition cost is 40. There's nothing for accounts payable, loan on land, which is 50%. There's vouchers of 140.
Okay, so when we say for loss purposes, this is it's presuming at risk, correct? Because this is saying we've jumped over the first basis hurdle, or let me be more precise. Acquisition cost jumps over the first hurdle and the second hurdle. AP jumps over the first hurdle, but not the second hurdle. So that's a 0. Loan, the qualified non-recourse jumps over the first hurdle and second hurdle, so we have a total of 140. That's what I'm trying to say. I might not, and I want to make sure I'm saying it well. Okay, go ahead.
Okay, basis for distributions, acquisition cost is 40,000. Accounts payable at 50% is 40,000. Loan on land at 50% is 100,000 for 80,000.
And the reason that AP is 0 for basis purposes, but 40 for loss purposes, is because it just allows non-recourse debt is available for distribution purposes. Okay, what's B look like?
Basis for B, basis for loss of acquisition is 60,000. Accounts payable is 0. Loan on land is 100,000 for a total of 60,000.
Okay.
Basis for distribution, acquisition is 60,000, accounts payable is 40,000, and then loan on land is 100,000 for a total of 100,000.
Okay, and this is going to sound like a super simple question, or I think it sounds super simple, and to the point I might be. Well, we're trying. It's clear, Allie, to you and everybody else in the room. We're tracking the first column for loss purposes, and we're tracking the second one for distribution purposes, and both those are 2 separate lenses that interact with debt completely differently. Okay. Okay, so you might want to flip pages, right? Go to the next page and keep this page, because we're saying partner A has, and this is the section I was talking about earlier, to say, well, you got to do an analysis of the balance sheet to say what's on the balance sheet and where does it go. For A, it was 40,000 of non-recourse debt, 100,000 of qualified non-recourse debt, and that information is very, very useful for whoever's using that K1. So let me ask a stupid question. Who you want to call in, Allie?
Sam.
Who?
Sam.
Sam? Let's say for 1 second, Sam, that Stuthman was doing this return, okay? And he treated the AP and the debt on land as non-recourse. So that would infer that line 1 was populated with 140,000 and the non-recourse, qualified non-recourse was populated with 0. This entity has no other basis. He had 0 acquisition cost. And this entity has $100,000 worth of loss. And we issue this K1 to people outside the firm. Did we just do a disservice?
The answer is yes, but I can't tell you exactly why.
Okay, so So let's go back to our hurdles. Our hurdles, we say that Stuthman has a K1 with $100,000 loss. Correct? So now we got to do the analysis of whether he can take that loss because we got to jump the hurdles. In Stuthman, he has acquisition cost of 0, and per the K1, non-recourse debt of 140. Right? So does he have basis to jump over the first hurdle?
Yes, it would just be right. He doesn't have an acquisition cost.
Okay, so if we go back, so let's stop here for a second. Can anybody help Sam out at this point? You can help him out?
Yeah.
Okay.
It's non-recourse that it doesn't get you to the first hurdle.
So take him to that page where we're talking about partnership losses. You know, where the lines come across. Okay, so this is this the page?
Matt? Yeah, still
Still
Ron?
Ron?
Okay.
Okay, so why don't we talk through what's happening? Okay, and tell everybody what you're telling Sam because I'm lost at this point. I don't know what the hell's going on.
So there's originally just a 40,000 non-recourse debt, but he said, hey, what if we messed up the K1, we took 100,000, and instead of saying it's qualified non-recourse, we consider it.
Okay, so let's push that. Let's push the error aside just for 1 second. Let's not worry about that because we'll come back to the error just to drive the point home. Let's pretend for 1 second that the K1 in this case is accurate. He has a $100,000 loss, and the K1 we know he has 0 acquisition cost, so he didn't put anything in. Everything is debt funded. So he did operations first year. He has an account payable to Lutz for 140,000. And now he has negative equity of 140,000. That would be the balance sheet. Okay, so now you get this K1, and now do we have the ability to jump the hurdles with that $100,000 loss to offset his $200,000 W2? So tell us how we do that analysis.
Looking at this thing, you're looking at the non-recourse debt, which is the AD. You can see it runs on a basis and gets stripped up on that first hurdle. So you're not going to evaluate the rest of the hurdles, and it's not going to be a loss there.
Okay.
So it'll be pure, or not pure.
Okay, so let's do this again, but just break it down even a little smaller because you did a really nice job, Matt. Okay, so we know he has no acquisition cost. Does Brad have acquisition costs? No, so that doesn't help us over the hurdles. Did he make a loan to the entity? No, he did not. So that doesn't help us over the hurdle. Does he have any debt-funded acquisition costs? His acquisition cost 0, so no. So there's nothing down here, while if they existed, could get you over the hurdle. All these are populated with 0. Nothing here helped you get over the hurdle. Okay? Does a recourse debt? Yes, 140. So if we come over here, is 100,000 loss larger or smaller than 140 of non-recourse debt? Smaller. So the fact that we have non-recourse debt allows that $100,000 loss to hop over the first hurdle. Then we say, well, wait a minute. Now we got to get over the second hurdle. Well, non-recourse debt doesn't get us any further than that first basis hurdle. Okay, so now do we have any recourse debt or qualified non-recourse debt or guarantees? The answer is no. So since the answer is no, we trip up at the first hurdle. and the $100,000 gets lost. Okay, so I'm going to pretend for what we just did that this was accurate. This was an accurate K1. Now I'm going to take the second step to pretend that we screwed it up. And instead of reflecting the K1 as we should have, to say there's $40,000 of non-recourse debt and $100,000 of qualified non-recourse debt. Stay on that page, Sam. Do we have enough basis to get over the first hurdle?
Yeah.
How much basis do we have at the first hurdle to measure against what the loss is per this K1? We have zero acquisition cost plus this debt. That's the universe of basis that we have. How much basis do we have?
In the one where it's 40 and 100.
Yep.
Either full. I don't know.
It's 140. Okay, it's 140 of basis. So that allows us, we have 140 basis at the first hurdle. We have non-recourse debt of how much, Sam?
40.
And how much of qualified non-recourse?
100.
Okay, so we have 140 of basis, correct? Okay, so we have 100 of loss, we have 140 of basis, correct? So we're able to jump that hurdle. So how much recourse debt do we have? Or how much at risk do we have?
Would that be the qualified?
To be the qualified non-recourse. How much is that?
100.
100. How much is my loss? So it jumps over the hurdle to get to passive. Okay. So now if Brad inappropriately, and this goes both ways, if Brad inappropriately prepared this K1 and what it should say is non-recourse of 40 and qualified non-recourse of 100, what it should say is that, but what it said was non-recourse of 140. Have we told another provider that that loss gets hung up at the basis? Because our information is important for them to diagnose whether they can hop the hurdle. Okay, so in filling out the debt portion of the K1, we should not go, well, close enough. Because this has two versions of a tragedy. The first version is, well, we told somebody they couldn't take the loss. That's tragedy number one. The inverse of that is if the K1 should have said, 140 of non-recourse, 0, we'd be completely hung up there, right? Because we don't have enough to get over. Well, sometimes we're stupid in a different way. We say, instead of it being 140 and 0, we say 0 and 140, even though we shouldn't have said it was 140. And now we've released losses into returns that they didn't have the right to take. So what we're putting in that debt box is really, really, really important. It looks innocuous as hell, but it's not. Okay, and then we have B having the same K1. Allie, who you want to call in?
Partnership is owned equally by A and B. A has guaranteed all of the debt associated with the land based on the following facts. What is A and B's basis for distribution and loss purposes? And then there's a little schedule there that says A contributed 65,000 in acquisition. B contributed 40,000 And B has a loan to the partnership of 60 and A does not. Do we?
Okay, so let's stop there for just 1 second because now we have a few more moving parts, I think. Because we had, if you go back to keep this page, but you go back to page 4. Okay. Do we have non-recourse debt on the balance sheet, Jackson?
Yes.
You do.
Yes, we do, because we got it.
Do you have non-recourse debt that's qualified non-recourse debt? Do you have qualified non-recourse debt?
I believe the land would be.
Do you have a loan guaranteed?
Yes.
Okay. Do you have acquisition cost?
Yes.
Do you have a loan to the partnership? And do you have debt funded acquisition cost?
Yes, maybe.
You do, I don't know, I can't remember. What's
I can't remember. I don't know if that is or not. Loan B.
No, that's a loan from the shareholder.
Oh, okay.
Right there.
No, so then I would say
I'm going to say you don't. Okay, so now you have this page to Sam diagnose who gets what of each component. Okay, so on this page, Jackson, we have non-recourse debt. How should we allocate non-recourse debt to A and B?
probably just by the ownership percentage, unless there's something else.
Ownership percentage, unless there's something else, and I can't tell you of a time that's not ownership percentage.
Okay.
Okay.
So now you know you have a procedure on what to do with that non-recourse debt. Do we have not qualified non-recourse debt?
Yes.
Okay, and what should we do with that?
It's going to be pro rata as well.
It is. Okay, then we have loan from bank guaranteed by partner or shareholder.
That's just going to go to the partner guarantee.
And why does it go to the partner who guaranteed it, Chris?
Because they're gonna have their shit taken.
Because they're going to have their shit taken. You're getting more gangster by the second. Okay. Okay, so you have acquisition costs, which you've been given that data point, have you not? Do you have a loan from a partner?
Yeah.
Who would that go to?
It says B.
So B made the loan, correct?
You made the loan for 60,000.
Okay. Do we have, and we've already said that there's no debt funding. Okay. So in order to diagnose, you have to stop and say, what debts am I dealing with? So what Jackson and I just did was stopped and said, well, let's look at the balance sheet. Let's look at the loans from outside the entity, quantify what they are and who they go to. And if I was tracking what you said, and you can tell me where I'm wrong, what?
Screwed up.
Okay,
Just
sorry.
the information, A guaranteed all the land.
You didn't you say that earlier?
No, I said pro rata.
There's no qualified non-recourse?
There is, but he took it. And I said that they were going to split it. So
The land loan,
he gets it all.
land loan?
Yeah. Says he guaranteed all the debt with the land.
Okay, all right.
That's
Okay, all right, yep.
just
All right, nope, that's okay. But that's good, right? From the standpoint that you have to take each individual piece and Sam diagnose where it goes. So what he said, and what page number was that? I can't remember. 12 maybe. Is this it? No. That was right.
Yeah.
Oh fuck. Okay. Nope. I completely ignored you. Okay, so we start with A and B with acquisition cost, correct? And then we have that page on page 4 to say the AP gets split equally. And then we say, well, there's loan from B. Who gets that debt? B does. Okay, so on the AP basis for loss, 0 base distribution 40. Loan from B, A gets 0 because B's the lender. And so this is also recourse, Chris, but this shit's already taken. Because the loan from B, if the company goes down, he just lost the loan he made to the company. That's different than a guarantee. His it's at risk, but they can't take any more than that. Okay? And then a loan with respect to land, A is the guarantor, so that has to go all to A. And then the acquisition cost for B, 50-50 on the AP. B made the loan. The loan on the land is 0 to B because A did the guarantee. So is it important that you take the liability side of the balance sheet and say, who does this attach to? And it's important that we make a schedule to get that on the K1 so we don't screw up and tell another firm either they can or can't take a loss. Okay, so A has 40,000 of non-recourse, 140 of recourse, and B has 40 of non-recourse and 60 of recourse. Who agrees or disagrees that that's correct? Who has any questions at this point?
So essentially everything has basis. Like you have basis in everything, whether that's your debt. It's just a matter of non-recourse. You can't take that for loss purposes.
Can't take it for loss purpose.
But you still have technically basis in your debt.
For partnership.
Correct. Yes, for partnership.
Okay, but what if I don't correct that, somebody in the room is going to say, well, there's not a distinction. Yes.
But so that first hurdle is most likely everything is getting over that hurdle for the most part. Unless you have 0 basis, like you have no debt, you have 0 acquisition costs.
I don't know how you get a loss. I mean, it has to be a debt funded loss. The loss has to come from somewhere.
Most likely everything is getting over that first hurdle and then the at-risk hurdle is where things get a little sketchy.
Correct. That's 100% correct. But you also have to say, we've also been talking about distributions, right? For distributions, non-recourse counts for distribution for partnership. It doesn't for S-Corp. Okay, so I mean, there's all sorts of nuances. It's what lens are you pulling out to figure out what you're dealing with?
I'd say like when you're looking at an S corp, like look at the form 7203.
Yeah.
And it'll kind of lay out, and like if you actually like look at it and read it, it'll kind of make a lot more sense of what counts and doesn't count. And I thought that was helpful for me at least.
This is the Brad Stuthman be intellectually curious portion of the conversation. This is where I tell them they can. Brad, do I care if you succeed or fail?
No.
I don't. I would like to see you succeed or fail. I mean, I would like to see you succeed. Right.
You'd like some.
Shut up.
So I want to see everybody succeed. But that success is not mine to grab a hold of and to pursue. It's yours. And good luck and let me know how it turns out. Now, with that said, I love should people be scared to come into my office? No. They shouldn't be. But I'm going to presume there's more than 50% of the room after this, they'll still go, I'm not doing that. It's like going into the lion's den because he's going to ask me questions that make me uncomfortable and make me feel bad about me. And you know what? I am. And I don't care because at the end of the day, your discomfort and your failure is ultimately your success. Because I genuinely don't care about your comfort when it comes to this. Now, I don't want to be mean to you and I don't want to beat you down. I'm not going to go out of my way to make you feel poorly. That's not what I'm saying. But if you come in and say, what about X? There will be a series of questions. I'm going to find a point of reference that you and I can share. And when we have that point of reference that we can share, we're going to pick other data points up around that point. And then we're going to build around that point to help you go, oh, that's the conclusion. Because at that point, if you go through that process, if I just say, here's the answer, pat you on the head, and send you out of my office, you're no better for that. You're not. But if I sit there and say, here's point of reference we can both agree on. Here's other things that you know. Here's how you can correlate to this to what the real answer is. And then we're building additional what, Chris?
Foundation.
Because everybody in the room, I think, or some people in the room say that they want to consult. And in order to consult, Max, do you need to know something or can you know nothing? You need to know something. And the only way you're going to learn something is is it through 100% success? No. There's a lot of failure in there. I mean, there is a lot of failure. So come in, seriously, doors open, come to my office, and I will make you uncomfortable. And I take joy out of making you uncomfortable. So let's be clear about that. But I do it with your best interest at heart. I don't even know how I got there. I blame you, Stephen. Okay, so this is another version of me trying to maybe, and I left all these in here because everybody's mind works a little bit differently. And the more we turn over the concept, the better we are for it. So the first one was a version, and then the version where I got the stop sign saying you got to stop, here's another version, and now here's another version. We discussed basis for distribution purposes and loss for purposes for S Corp and partnership. And what I have is the top grid is partnership distribution and S Corp distribution. And I say, well, debt. And I believe we have debt, which is recourse, non-recourse, yes and yes, no and no. It does not help for distribution purposes. Non-debt basis, acquisition cost, loan to entity, yes all the way down. Fuck. Somebody could have caught me. This should be a no. Brad gets to hand out the first gift card today. I've just decided that. It's going to be your responsibility. And then you're going to have to tell them why. And it can't be because they said I'm happy about something. I've already negated that rule. Okay. So for loss purposes, partnership loss, recourse debt, yes, non-recourse debt, no. And I should say recourse debt and qualified non-recourse, just so you know. I've lumped them for purposes idiotically as one item on here. So to be more precise, if you want to write on your page, qualified non-recourse and recourse, that might be smart since I've said it. I mean, it applies. Non-recourse debt, no. Acquisition, yes. Acquisition cost depends on whether it's at risk. Loan to entity, yes. S Corp, there's nothing on the balance sheet of the S Corp that allows you to take loss except a loan to the entity, and that's down here. Acquisition cost, acquisition debt depends on whether you're at risk, and loan to the entity. And people ask, well, when are you not at risk for a loan? Well, if I decide that I'm going to try to transition my son or daughter into my business enterprise, and I say I'm going to lend you $100,000 so you can buy into the entity, or my entity says I'll lend you $100,000 to buy in the entity, and then it goes south, do you think I'm going to shake my kid down in court for the $100,000? Probably not. So those kind of loans, it's arguable whether they're at risk or not.
And then one thing I probably want to add too is when you're looking at like, if you get a K1, like Pete said, from an outside firm or whatever it is, that partnership basis worksheet that's usually attached, that is more of the, I'll call it the first hurdle, the basis hurdle, because the debt that's included on there includes both, includes all three types. So you have to do kind of like Pete said, the further analysis of looking of what makes up that. 'Cause just because there's basis of 50,000 on that worksheet, all of it might be non-recourse, so you might not have basis to deduct that loss. So just something to know.
It's really good something to know. I mean, I've looked at that, and now that you say that, because Brad, can you tell him what my goal is?
To retire.
To retire. You know, as soon as I possibly humanly can, I want to retire. So there are things that when I was your age, that's the stuff I knew because it's important. I had to interact to make that SAM diagnosis. And the only way to make diagnosis is to know exactly what I'm looking at. And what Brad just said was the fact that I don't really look at that basis schedule coming off the partnership. I have the inability to convey that non-recourse, qualified non-recourse, and recourse debt are lumped into a single number if I'm tracking with what you're saying on that basis schedule. And so what Brad's saying is you have to be smart enough to, Sam, diagnose the pieces that are embedded in that debt number. And where exactly would you look to diagnose that? Jackson?
Agreement documents, probably.
Nope. We even talked about it.
J1.
Who said that? K1. Right? The debt on the K1 is going to tie to that basis number in that schedule. So in order to
Diagnose.
you got to look at the K1 and break that number apart into its individual pieces to understand whether you can jump a hurdle or not.
So that's probably more for, if we think about it, that's probably more for distributions purposes, because like Pete said, you get, I'll call it, not basis, but you get credit for that non-recourse. So that's more of for a distribution analysis, I would say more so.
Yeah, I think that's probably right.
Does the software ever calculate for you? So it's like, okay, when you enter in those like recourse, non-recourse, does it say like, hey, you're in a loss position and your basis is at,
No, it doesn't. I'd say like,
so you have to go and analyze basically.
yeah, because like Pete said, there could be stuff that might not be on there, like the debt funded acquisition cost may not be on there, and depending on how well we actually track the basis in the past on that schedule, whether it's accurate or not.
How often do we get accurate basis schedules from other client or other providers?
We do the best we can in asking them, and I guess technically you're supposed to go back from inception of the corporation or partnership.
Okay, so now I'm going to ask the embarrassing one. How good are ours?
Not the best.
Not the best.
Better than some.
Better than some. The IRS has made us more of a, going back to Leslie's discussion on foreign, the FBAR, the 86865, or whatever those forms were that I'll never be able to remember. These basis forms, there's all sorts of things. What's this new fucking business reporting? We're going to tell you who changed owners.
EMI
Yeah. What's my goal?
to retire.
This kind of stuff really wants to make me retire because it feels to me the IRS between all these things is grabbing information that they have no real right to. And this BOI thing is really scary to me. Well, why don't you tell me exactly what you have and tell me about your ownership changes? And, it's almost like the Stasi. Does anybody know what the Stasi is except Carter? Do you know what the Stasi is? Really?
No, I don't know if that is.
Based on our conversation last night, I think it's the Stasi. They're the East German intelligence agency, and they spied on everybody. Okay. Hey, my tinfoil cap's in the car, so look, I'll go get it. Okay. So, but the basis schedule for partnerships, basis schedule for S corps, that's new within the past 5 years, maybe 10. I don't know. I hate it. But to be clear, they're absent these basis. I get the impetus of the basis schedule, even though I hate it, because there might have been a little bit more leeway in people raising their hand on a distribution in excess. Maybe. Not that I've ever done it. Not that I've ever said to a client, you have basis, don't you? Yes, I have basis. All right, whatever. Okay. This is another version. Basis, do I have basis in the asset? If yes, go to at risk. If no, stop, it's lost. It's disallowed. At risk basis, do I have at risk basis? If yes, go to passive netting. If no, stop, it's disallowed. Reported on Form 6198. Passive netting, if non-passive, move to excess business loss. If passive income, you have to run through passive netting. Is the passive loss from is the loss from passive activity? If no, go to excess business loss. If yes, net all passive income against passive loss. If the net amount is lost and it's suspended, and you have to report on Form 8582. So there's another form that probably is worthy of highlighting. Is the at-risk hurdle is reported on Form 6198. The passive hurdle is reported on Form 8582. Then excess business loss. If I jump every single one of those hurdles, I get to excess business loss. Excess business loss, you have to net all income and loss from business activities. Does the loss exceed 500K for married filing joint, 250 for single filers? That's not inflation adjusted, is it?
I think it is.
It is?
I think so.
Can you look that up?
I think they start going on
I don't pay attention to certain things. Okay, so according to Mr. Stuthman, this is inflation adjusted, and he's going to look it up. Okay, so if the answer is yes, it exceeds those numbers, then you have an excess business loss. The excess business loss that was limited is carried forward and converted to net operating loss.
305 and 610 for
305 and 610 is your numbers. 305 for married, for single, and 605?
305 and 610.
610. Oh, I should be able to do that math. 610 for married filing joint. And seriously, remember how I talked about depreciation and how I used to know everything about depreciation? Now I know nothing. I used to know that number like the back of my hand. So the fact that I'm old, tired, and don't care doesn't mean that you should take a page from that playbook. You guys should care and know these things.
Then one thing I'll add on this too is, I mean, for me at least personally, this is what finally, this sheet right here exactly is probably what made 1040s make the most sense for me. Because, you know, a lot of our clients, you just go in there, you punch in the whatever numbers on the first page of the K1, you're like, oop, I'm good to go. We'll send it to review. I typed in the numbers right, I think, maybe. And then, you know, you never probably actually look at the Schedule E. At least I didn't when I first started. And I'd say it's probably one of the more, I'll call it important forms, but our software is not the best of, okay, when you punch in all the K1s, make sure you look and say, okay, there's losses on these 5 of 10 K1s. Should we be able to deduct it? Is it showing up? And if not, why? Because there's some inputs at the bottom that's kind of funky where you have to put different, you know, loan and debt basis at, there's like 5 spots and stuff to put like that risk versus there's a basis spot, then there's an at risk spot. So just making sure that.
You're talking about access input.
Yes, like in the software for the tax return. Just make sure when you're done and you have losses running from K1s, you say, hey, does it make sense? Should we be able to take this loss? Yes or no? Is it showing up? Yes or no? And if you can't figure it out, ask someone how to get it to flow through after you go through this analysis. Because I'll say, it's if you just type in negative 500,000 and stuff ain't set up right, or you don't type in certain things right, it ain't gonna work. So just something to be mindful, and you know, ask them questions. Does this make sense when we're all said and done? And then if it doesn't work, because otherwise I've seen instances where we should have been taking losses, we haven't, just
purely because we haven't entered stuff right in the software. So just something to, I would say, take one thing away, take away this main sheet, you'll learn a lot about going through 1040 season or whatever. It'll make a lot more sense.
Wait a minute. Are you dissing on my binder 2, 1231?
Well, that's up there.
That's up there.
I'd say this is probably more critical,
Okay.
in my opinion.
It cracks me up that you and Noodles think it's a good one.
It was. We finally figured out we might kind of know something.
And the only way you're ever going to be able to consult is by what?
Knowing something according to Max.
According to Max? Is that what it is? Max, you agree with that? You didn't know that?
It's like maybe it's old. I don't know.
Let's see. Evidently, we have an example. But and maybe this is in play. But I want to talk about this NOL piece of it. Do you guys know how the NOL works? Anybody? Okay, so it used to be when you created a net operating loss, you could carry it back depending on whether you're a corporation or individual, a certain number of years, and they carry it forward for a defined number of years. And in 2017, there were 2 changes to that. One was, we're not going to allow you to have an NOL in year 1. We're going to put in this excess business loss set of rules. And 2, the excess of whatever that limitation was is going to get carried forward into year 2 and become an NOL. And that net operating loss can't be carried back. It is now carried forward in perpetuity. So in exchange for not carrying it back, they allow you to carry it forward in perpetuity, but I can't remember who said there something about this 80% limitation. So let's talk about what this means. So under the old rules, if I had $100 of NOL, I could carry it back 2 years and forward 20. That's the old rule. I'm going to call it $1 million. $1 million, I could carry it back 2 years and forward 20, and there was an expiration date on that. And actually, that's worth knowing. Now that I'm saying this out loud, the reason that's worth knowing is we have corporations and individuals that have NOLs from 2017. So NOLs 2017 and prior fall into that rule. So the carry back piece of that, you don't care because the carry back piece has already occurred. There's nothing that you can do with that. The carry forward piece of it is the piece that's worth knowing, because we have a client that has an NOL from 2005, and what year is it?
2024.
2024. Is 2025 coming up?
I think so.
So if you have a 20-year carry forward, that NOL either needs to get used or it just dies on the vine and expires. So the pre-2017 NOLs have a shelf life. 2017 and after, you don't have to get a carryback, but it has a shelf life. And the only way you get to a 2017 NOL is by having a loss that's in excess of your excess business loss. So for ease of math, I'm going to stick with my numbers of 500,000. If I have $1.5 million loss that comes to me on a K1, and it jumps all the hurdles to get to my 1040, in year 1, I have this excess business loss problem. It says I can only use $500,000 of that loss from that K1. So my deduction in year 1, I have $1.5 million of total amount of loss off my K1. Excess business loss says I can only use $500,000. Okay, so $500,000 offsets my income in the current year. Now I got this delta, or this excess over that excess business loss of $1 million. That $1 million goes into year 2. So now you say, well, how do I have to interact with that $1 million in year 2? Well, the way I interact with that $1 million in year 2 is I have this 80% limitation. It can offset any kind of income, but there's this 80% limitation. So let's talk about what that 80% limitation is. That 80% limitation is keying off of, it's got to be taxable income, I think. So if my taxable income is $1 million, 80% of $1 million is 800,000. Okay, so that's the ceiling. That's creating a ceiling amount. I get capped. I bump into a ceiling with respect to the amount that I can utilize. So $1 million taxable income times 80%. Find my ceiling, which is 800,000. I have $1 million NOL. I can only use 800,000 of it. So I got $1 million of taxable income. I got $800,000 of NOL, $200,000 taxable income. So the trap in this, though, is it's too easy to shortcut to say that I have an 80% limitation. Well, how much NOL do you have? I've got $1 million. How much can I use? 80%, 800,000. That's all I'm ever going to be able to use. Don't do that. That's not correct. Because the 80% limitation should not be viewed as a lens with respect to the NOL. It should be the lens that you should be using is what's my taxable income. Because it just happened in my example that my $1 million of income and my $1 million of loss were the same. They were congruent. But if I take my taxable income up to $2 million, I use that $2 million of taxable income to find what my ceiling is. In order to find the ceiling, I take the taxable income of 2 million times 80%, it's 1.6. Found my ceiling, what NOL do I have available? $1 million. I can fully utilize that $1 million. So I got my 2 million of income, $1 million of NOL, now I have taxable income of $1 million. Do not fall into the trap of, well, it's an 80% limitation on the NOL. All I'm ever going to be able to use is 80%. Well, that's true, but you got to use the right data point in the calculation to find the ceiling. It's not the NOL.
Pete, where does the NOL show up on the 1040?
Brad, where's the NOL show up on the 1040?
It's on the carry forwards.
It's on the carry forwards. I'm glad you knew that.
I think there's like an NOL like worksheet and stuff in there as well. But
I'm ashamed I didn't know. That one I should have known. But that seems like a reasonable answer to me. Because, Chris, how many answers are there?
Correct answer? I don't know.
And I didn't know. I couldn't remember whether there was a form that was on. I was having a very senior moment when you asked that. And there are times when I get asked a question, like, I really should know that one. I should feel some level of shame that I don't know that one. And that's what you just did to me.
Like Big worthy?
No. Making me feel shame? Are you kidding? Do what? Hold on. Who all has gotten a gift card? Okay, let me do it the inverse. Who has not? There's 3 of you that have not. What is wrong with you? I've been handing them out like chiclets evidently.
I'm trying to call you out on one.
What's your problem, CB?
I guess you just don't like me. I don't know.
Is that what this is?
I'm not gonna buy.
You strike me as a Stillwater's ghost. How many shots did you do last night? No idea. Anybody got a guess on CV?
Like, 2 or 3 of the arcade bar.
Yeah, Irish Drop on. Yeah, Love Drop. Yeah, Jameson's.
You strike me as Stillwater's go deep. I wish you would be worth sticking around just to be a fly on the wall, just to see what the hell would happen. That's what you strike me as. What's your problem, Luke? Why haven't you gotten the card yet?
Brain fog, probably.
Brain fog?
Yeah, I mean, I don't know. I try to think of good questions and they don't come up right.
Oh, Brad, you're gonna have to find a way to get at least one of them a card. Now he's the guy. I'm no longer the guy. I've transferred responsibility to
Brad, I'm not too sure.
I already know how I'm deciding it.
You do? Okay, I can't wait.
Also, it shows up on Schedule 1, the NOL.
Oh, yeah, in terms of being able to take the deduction. See, I barely knew that.
Before taxable, that gets you 2 taxable.
Just.
What? Yeah, it gets you 2 tax. It's
Yeah.
is that pre or post?
There's like a whole like netting worksheet. You'll find it if you have one. So,
And Nebraska NOLs are a pain in the ass, aren't
They never work in the software, and they're troublesome if there's an excess business loss in prior years, and if there's multi-state. If you have your NOLs generated from Iowa, Nebraska, Kansas, wherever, just like the non-Nebraska add back is confusing. So if you see that, just ask. I still don't. Fight there's a good
don't
reason.
ask
Yeah.
me. We all know not to ask me. I mean, I'm serious. Ask Brad or somebody that actually is capable in the software.
There's special calculations you kind of have to do because it just doesn't work. And then the excess business losses, correct, Pete, turn into an NOL.
In year 2.
Because I don't think our software captures that for Nebraska.
You just made me sad in a sentence. It should. CV, how we feeling?
Like $1 million.
How about we take a break for 5 minutes until we do the next example? Give everybody a break.
That works.
All right.
Yeah.